The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us today for our webinar, Today's Investment Landscape for Today's Closed-End Funds. We want to take a moment and remind everyone that you're welcome to ask questions during the event by typing them into the Questions tab on your console. We'll do our best to answer them during the event. For those seeking CFP credit, instructions will be posted a little later on in the webcast. At this time, I'd like to introduce our moderator and panelists for today. Our moderator today is Mariana Bush. Mariana is a closed-end fund and exchange-traded products senior analyst at Wells Fargo Advisors, providing financial advisors and their clients with individual security recommendations in the CEF and ETP universe. Mariana began her career for Furman Sells in New York as an associate analyst following technology companies long before the internet became a household name. She joined Wells Fargo Advisors in 1991 as an analyst in investment strategy. Mariana began following CEFs in 1993, and she assumed coverage of ETPs in the late 1990s. Mariana has been widely quoted in publications such as Barron's, Businessweek, Forbes, TheStreet.com, and The Wall Street Journal. Our panelists today, we have Jonathan Diorio, Director at Blackrock. John Diorio is a member of Blackrock's Product Management and Development Group. Mr. Diorio is responsible for U.S. retail product management, development, and strategy within BlackRock's U.S. Wealth Advisory division. In addition, he's responsible for overseeing BlackRock's closed-end fund business. Prior to joining BlackRock, Mr. Diorio held various roles at DWS Investments, the asset management arm at Deutsche Bank. Most recently, he was director at DWS Retail Sales Division. In previous roles, he was head of closed-end funds for DWS, along with a portfolio specialist for DWS's alternative mutual funds. We also have with us today Ken Fincher, Senior Vice President and Portfolio Manager at First Trust. Mr. Fincher joined First Trust Advisors in November of 2008 after spending the previous 3 years at Calamos Investments and 17 years at Nuveen Investments. His current responsibilities at First Trust include management of separately managed accounts that invest primarily in closed-end funds. Previously, his responsibilities at First Trust include the development of new product structures in the closed-end fund space. At Calamos, Mr. Fincher served as product manager and client advocate for the Calamos closed-end fund and open-end mutual funds. In this role, he worked closely with the strategic alliance partners as well as intermediary distributions, portfolio attribution, CRM, and marketing teams. While at Nuveen, he spearheaded the development of the dividend advantage structure that enabled Nuveen to raise significant new closed-end fund assets, as well as development of the first publicly disseminated closed-end fund index and the website etfconnect.com. Mr. Fincher has been named Outstanding Individual Contributor to the closed-end fund sector in 2004, 5, 6, and 7 by financial analysts and his peers in the closed-end fund community. We also have with us today Robert Bush, Jr., Senior Vice President and Director of Closed-End Fund Products at Calamos. As Director of Closed-End Fund Products, Bob Bush is responsible for optimizing the firm's closed-end fund business. He acts as a liaison for the firm, communicating with the investor, research, and broker communities about the Calamos closed-end funds. In addition, Mr. Bush works closely with the Calamos executive, investment, marketing, and distribution teams regarding product development, strategy, and enhancements for new and established closed-end funds. He joined the firm in 2012 and has 29 years of industry experience. Previously, Mr. Bush worked as a managing director in the Financial Institutions Group for Citigroup Investment Banking. In this capacity, he was responsible for the closed-end fund product development, syndication, and capital raising for that firm's asset management clients. Subsequently to his investment banking career, Mr. Bush worked as a financial advisor for Morgan Stanley Smith Barney's Wealth Management Group. Without further ado, I'll pass this on now to Mariana to begin our webinar. Mariana?
Thank you very much, and good morning to everyone. Thanks for joining us. I know that you will very much enjoy the comments from John, Ken, and Bob, individuals who have been covering in closed-end funds and been working in the closed-end fund universe for decades. So with that, I'm going to have kind of a conversation with them. I'm going to ask them some questions, and please feel more than free to submit your questions, which I'll try my best to weave into the questions. So let's start with a topic that everybody is talking about, has been talking about for some time, interest rate sensitivity. John, can you tell us what are your thoughts on the interest rate sensitivity among closed-end funds? What is likely to happen?
Sure, Mariana, and good morning, everybody. First, I think when we talk about interest rate sensitivity, we have to talk about what is it that we mean by interest rates. And what I mean by that, Mariana, is there are short-term interest rates, there are intermediate interest rates, there are long-term interest rates. And I think the two concerns that are broadly out there right now in the closed-end fund market is that longer-term interest rates, 10-year, 30-year bond interest rates are going to increase. And therefore, closed-end bond funds that utilize leverage and have some interest rate risk to them and have what we call duration risk, which is obviously the sensitivity to a move in interest rates, that as interest rates rise, those funds may see price depreciation. So I think that's risk number one. And then secondly, I think the other risk that people are concerned about is that short-term interest rates may increase. And what I mean by short-term interest rates are things like Fed funds. So obviously there's been a debate going on for quite some time now. When is the Fed actually going to move? We can comment on that in just in a moment. But what will Fed funds and LIBOR and SIFMA, which is the going short-term rate for munis, what will those rates do? And as short-term interest rates increase, closed-end funds that use leverage and enhance their yield through leverage will borrowing cost increase, and how will that affect the distributions or the dividend yields of those funds? So those are the two concerns that are out there. And the result of that, Mariana, what we've seen at Blackrock is that it's caused closed-end funds really since the taper tantrum of 2013. So if we all remember back when Ben Bernanke said that he was taking his foot off of the gas, that closed-end funds have really traded at fairly significant discounts since that period. And since then, as we all know, interest rates really haven't moved all that much. There's been some volatility with interest rates. They've gone down, they've gone back up, but they've fairly stayed the same on the long end of the curve, and short-term interest rates have not moved at all. And so with that, our view at Blackrock, maybe just to summarize, is that we do think the Fed will move this year, but we think the pace of that move will be very, very slow. So we are calling for the Fed to move in September. Now with everything that's going on in Greece, we're debating that internally, whether or not it'll be September or December. But the bigger point is that we think the pace of it will be very, very gradual, and we do not think you're going to see short-term interest rates or Fed funds move up very, very quickly, which should contain that risk of how quickly the increase in borrowing costs goes through to fund investors. So that's point number one. And then point number two is our thesis is that we're going to be in this low for longer environment. If you think about the demographics, what technology is doing to the economy, and just the overall demand for fixed income assets, we think the 10-year Treasury, while it will likely creep up, we do not think you're going to see explosively high interest rates on the intermediate to longer part of the curve. So with all of that said, what we believe that means is that there's some pretty good opportunities in closed-end funds. One, I think it's important to remind everybody that not all closed-end funds are fixed income funds, and so you have some equity funds out there that really have nothing to do with interest rate sensitivity, and you're seeing some of them trade at discounts. So the first thing we'd advise everybody to do is don't lump closed-end funds in together. Really look at the underlying asset class. And then number two, really think about what your view is and where these closed-end funds can fit into an individual portfolio, because duration and interest rate risk is not always necessarily a bad thing. Even if you think interest rates are going to rise, duration may give you a buffer versus something like an equity market sell-off, and can be used in an overall portfolio for various reasons. And then lastly, we think closed-end fund discounts right now are compensating you for any potential rise in interest rates. So that's another way of saying I think a lot of this, Mariana, is already priced in. And the example I'll use is munis. We're at Blackrock right now seeing munis trading pretty attractively. The historical discount on munis going back some years is only about 2 to 3%. if you go back over the last 5 years. But if you look now, discounts in munis are around 8 to 9%. And where that's putting muni closed-end yields is in the mid 6% range. And so if I do a tax equivalent, if you're in the highest tax bracket, that yield comes out to 11%. So that's some pretty attractive yields within the muni space. A 6.5% yield on average, which equates to a tax equivalent yield of almost 11%. And so if you are looking for yield and you do have our view that interest rates are going to be low for longer, we think using a municipal closed-end fund along with maybe some type of shorter duration municipal portfolio or short duration bond fund and barbelling those two things together can make a whole lot of sense. Certainly, we don't think you want to put all of your money into a municipal closed-end fund because there is some duration risk there, so you have to be careful. But again, using it in an overall portfolio context, especially for investors that want income, we think it's a really good, efficient way to get income right now. And we think there's some really good opportunities because we think the market is overshot given the discounts that we're currently seeing. So that's some of our views, Mariana. I'll turn it back over to you.
Great, thank you, John. So just to repeat something very important that I think you said for the participants is closed-end funds are not an asset class. You need to look through what is the underlying asset class and how interest rate sensitive or what are the risks, how is it likely to behave, which is important to look at. Now, John, you already told us a little bit about valuation, specifically on the muni closed-end fund universe. Can you tell us a little bit more about current valuations and what the trend has been?
Sure, Mariana, and thanks, and good morning, everyone. I think if you look at it, as John pointed out, you got munis right now that are trading probably in that 9% discount range. Now, if you look back a year or two, a year ago they were at about 5.5% discounts, and 2 years ago they were at about 2.8% discounts. And so you've seen the trend as a little bit more uncertainties crept into the market as we begin to come closer to possible a rise in interest rates. John mentioned Greece. There's a lot of news in the markets today. You've seen investors really start to get themselves away from the muni space. And one of the reason I say that is if you look at a price index on muni closed-end funds over the last couple of years, and John alluded to this earlier, you haven't really seen a whole lot of movement in the price of the closed-end funds, but you've seen the net asset values continually climb because there's been such a demand for munis. If you fast forward into, let's say, the taxable space, a little bit different scenario. You've really seen the discounts widen out. Again, as mentioned earlier, 2 years ago we were about 3% discounts. Now we're about 10%. That whole fear of duration risk. But the story is a little different. What you've seen here, if you look at prices of closed-end funds, you've seen the price of closed-end funds over the last year really trade off considerably, probably on the plus side of 10%. And so the discounts have widened out really for two reasons. First and foremost is the price has fallen rather quickly. But second, you've seen that asset values remain a little bit more stable than what you might have seen. Again, it's the retail investor who invests in closed-end funds. They're starting to bet with their feet. They're starting to hear all the news. They're starting to take in all the potential increases in interest rates, and I agree with John in regards we think it's going to be a slow climb in interest rates, but nonetheless the expectations, the headlines have forced a lot of the retail investors to think about their positions and try to move out of these longer duration, longer dated positions, something that's been successful for them for the past 5 or 6 years. And so you've seen the prices drop rather quickly in the closed-end fund space. And really the third major category is the equity space. Obviously a lot of volatility here over the past couple weeks. Take Greece. This morning you're getting a little bit more of a roiling of the markets in China. And you've seen, again, the prices here trade off considerably over the last year. Discounts have widened out. They're over 9%. A year ago they were about 7.5%. So they haven't widened out too much. So here what you're seeing is both net asset values as well as the prices fall pretty quickly. Again, you're probably around 10-12% in terms of the fall in prices, Now this could be a couple of different things, both retail investing with their feet in terms of moving themselves out. You've seen a little issuance, and the issuance you've seen has been more on the equity side. And so from time to time you get weakness in the secondary market when new issues come to market. But the valuations, just sort of to go back, the muni valuations have been stable. I mean, you really haven't seen a whole lot of movement, and so the widening of that discount has really been predicated upon the fact that net asset values had continued to move up until probably the last couple of weeks, but retail investors just weren't interested in terms of driving the prices higher. But both on the taxable fixed income and equity, it's a little bit different scenario where you've seen prices fall, you've seen retail moving themselves out of these positions, and you've seen net asset values either in the form of the taxable space remain relatively stable, and in the equity space start to move down here a little bit more recently.
Thank you, Ken. And indeed, valuations that we're seeing currently, the average discount for the universe, it's very few times in the past that we've seen discounts this wide. Clearly 2008, but besides that, not much more frequently than that. Can you tell us, Ken, maybe a little bit on the demand side, any new players compared to what we've seen in the past? Can you fill us in on that?
Sure, Mariana, and obviously, you know, the past 5 to 10 years, we've seen a number of new players come into the closed-end fund space. We've seen it in the form of mutual funds outstanding in closed-end funds, exchange-traded funds. I know at our firm here, we do a lot in the unit investment trust side for investors interested in closed-end funds. So you're starting to get more of an institutional involvement in the space. Obviously, the oldest group in terms of that institutional involvement has been the dissident or activist shareholders that still are very relevant in the market today. So, but that's a good thing because it's starting to hopefully create more efficiency over the long term for investors. And I think it's very important what Mariana and John spoke about earlier. Closed-end funds have to be viewed as a structure. Need to start to look through to the underlying because they aren't all about just income. In some instances, I know the modern day closed-end fund has been more about income with the munis and taxable fixed income. But the original closed-end fund space is really predicated on total return. And the total return in many of these equity strategies that exist today. So a lot of these institutional investors are looking for the opportunity, are looking for the inefficiency. They're there, they're relevant, they should help our markets long term, and I think you'll continue to see more and more of them get involved because they note the inefficiencies that exist, especially in times like we're going through right now.
Thank you, Ken, for addressing the demand side. And maybe let's switch now to the supply side of closed-end funds. Bob, can you tell us about IPOs, new issues, trends that you're seeing, and anything else, any innovation that you may be seeing recently?
Sure, Mariana, and thank you all for the participation on this conversation. Good discussion. It's interesting, if you take a step back and you look at the IPO market in 2012 and 2013, and this is going to feed into a little bit what Ken was talking about earlier, and John. About $25 billion of new issuance was done in those 2 years. A large part of that was either in high-yield credit or MLPs. Those were sort of the hot topics, hot funds being done during that period of time. What happened then subsequent to that was the high yield market fell out of bed, and then of course you had the energy market fall out of bed, and that drastically impacted the performance of those funds. And so I think at the end of 2013 and going into 2014, the market was kind of in a conundrum. It had done a lot of issuance in those areas that were trading off, given that the market had traded off, and so the street, the issuers, were looking for ways to really enhance the product, the design of the product, not necessarily the investment thesis, which those come and go, but what can we do to make the product better for the end user. And so what you saw over the course of the last few issuances is, I would say, different enhancements that really had not been done before or had been focused upon in at least the years that I've been involved in the closed-end fund business. And as we talked as a group earlier, it is pretty interesting how it's moving. So you started to see developments of a term structure. Now, there have been terms done before in the past where, from an investment thesis, it made sense. But term structures are now being put in. Miller Howard put one in on a deal they did at the end of last year. Calamos had done it, 15-year term structure, in a deal that we did earlier this year. Allianz had done it. And basically, it was to give some type of assurance to the investor at the IPO that within a finite period of time, the stock price and the NAV would somehow come to parity if indeed the fund was going to liquidate after a particular point in time, call it 15 years. What it did was it alleviated the concern that you would be buying into a fund which would perpetually trade at a discount for as long as you owned it, or for perpetuity. Naveen, interestingly enough, is in the market right now with a 5-year term deal, which is very short. So we'll see how those go. The other thing that's interesting is clearly on the fee side. Naveen now is there have been a lot of pushback from, or sort of, I'll say, with respect to investors about the gross spread, about the commissions that were coming out of the NAV, which were obviously a hindrance to get the funds to perform well at the onset, given that many of them were coming out 4.5% down from what the purchase price was. And so what you're seeing is, like I said, Naveen is coming out with a deal this month where actually the gross spread is a 1.5% or somewhere close to that level. The broker, the selling concession is very low relative to what it historically has been. So again, it'll be interesting to see how that plays out. Other enhancements include the Calamos fund and as well as the Allianz fund, where there's a shareholder advisor purchase program in the Calamos fund, where the advisor is stepping in and actually buying shares through a 10b5-1 program on a non-discretionary basis. Allianz came out with their fund earlier this spring, where they have the same kind of enhancement, where the shares are being actually purchased by the fund. So, not in my career have I seen what I would call sort of revolutionary engineering to, again, the product, the design of the product, to make it more. To make it better for the user, for the customer, at least at the onset, to help the fund perform better at the onset and going forward. So, again, these are fairly new structure enhancements. We're going to see how it plays out, but I think it's fair discussion.
Thank you,
Bob. This is Ken. I'm
great.
sorry, Mariana.
Go ahead, Ken.
And Bob, I would argue even that we're probably in the early innings of these enhancements and these changes in the IPO structure, both on the fee side as well as some of the other things that the sponsors are doing. And I think that's a good thing long-term for the investor.
I agree. I think it's not only good for the investor, I think it's good for the market, because, again, it's like any type of product. Both the manufacturer and the end user want to have features that are going to be better for the product going forward. And I think, I commend the issuers and I commend the underwriters in working together to try to come up with something that I think is really a better product in the end. So again, fairly revolutionary. We haven't seen, as you know, Ken and John and Marianne, this is fairly we haven't seen anything like this, at least in our careers.
That's great to hear. Lots of changes, lots of innovation, and all good for the investor. And there's another area that I think is also some other corporate actions that I think is also good for the investor, and that is mergers. We've seen many more mergers in the recent past, in the recent couple of years, actually. John, can you tell us more about that, since BlackRock has also done a number of mergers among similar funds.
Sure, Mariana. As you mentioned, we have done several mergers. We continue to think about ways to bring, efficiency to our closed-end platform. And then, to your point, obviously, we always want to provide benefits to our shareholders. And so, what we've done is we've merged some of our closed-end funds together that are somewhat like in nature, right? And the goal of that is obviously to streamline our portfolio options, right? So we have the ability for better potential execution, and we address the fact that if funds are pretty similar to each other, do you really need 4 or 5 of them, right? So obviously it hopefully improves the visibility of our platform and makes it easier for all of you out there to understand what our product offerings are. We think there's a couple other benefits as well. We think it also enhances, hopefully, the trading of the fund to some extent, and obviously there's a lot of things that go into trading closed-end funds and how closed-end funds trade, and we'll try to go into that call. It's obviously that's been debated for years and years, and could take forever to discuss. But when you do a merger, you usually do get a little bit more liquidity. We can typically lower expenses. We've tried to do the mergers without obviously doing any dilution to yield, because we know yield's important. So we want to make this, as I mentioned, as a benefit to the shareholders. The other thing is we do believe it increases the marketability. Mariana, we talk to folks like yourself on the analyst side, and we hear a lot, if a fund's small, it's harder to cover. Obviously, there's less liquidity that people and financial advisors can buy. So obviously, if you improve the size of the fund, you can hopefully improve the marketability of it. And so for these reasons, I think what you've seen here as mergers have come into the industry, and we've obviously been an active participant, hopefully that's improving the supply and demand dynamic and continue to improve how closed-end funds trade.
Great, thanks, John. And I agree. On our side at Wells Fargo Advisors, we do have some liquidity restrictions when we recommend certain funds. If they are too small, unfortunately, no matter how much we may like it, we may not be able to recommend it, especially as we've grown over the years and have become a much bigger firm. So we clearly see mergers as positive, as beneficial to shareholders. So great to see what BlackRock and others are doing, and there's probably a few more that a few more mergers that we can see. Now, let's move on to another question, and allow me to make it a little bit broader. We talked about interest rate sensitivity, but can you talk about, just in general, during market weakness, it doesn't have to be higher rates, whether they're long or short, but just in general, market weakness, what do closed-end funds, how do closed-end funds typically behave? What should the callers expect of the prices, of the discounts, or the NAVs, the distributions? Can you give us?
Sure. More than happy. But before I go there, to follow up on something John talked about, supply. I think one thing that our market is really lacking in terms of supply is analysts. Mariana, your team does a great job, but we have seen the number of analysts shrink over the past 5, 10, 15 years in the closed-end fund space. So in many instances, advisors and their investors are sort of left on their own if they fall outside the 6 or 7 firms that have analysts. And so I would behoove a lot of the firms, the underwriters that are involved in closed-end funds, both on an IPO, to think about adding analysts to the space. We need them. I think they're very relevant in terms of what's going on today. Closed-end fund, as we mentioned earlier, is a structure, and we need those people to help the end investor. Again, this is a retail-based product, so the advisor as well as the individual investor really depend on analysts to sort of help them make heads or tails of the closed-end fund space. So without that little diatribe, moving on in terms of what happens with weakness, we're experiencing it right now. We haven't really seen a movement in interest rates that John alluded to earlier, really on the short end of the curve if we're talking about the Fed. But again, because this is retail dominated, and again, going back to my comments about needing analysts, because this is retail dominated, what you're seeing is people who are invested in closed-end funds that really maybe don't follow the market as closely as we do on the call. They're getting nervous. And so what happens is you start to see the bid side of the market, or the buyers start to walk away because they're nervous, and the investors start to walk away. And that's why we've seen this gapping out of discounts in the closed-end fund space here over the last, let's call it 3 to 4 months. Second quarter was just a bad quarter for closed-end funds if you take a look at the returns of the space. And that only sort of leads me to believe that the retail investor, because of uncertainty, because of perceived weakness, they're starting to say, you know what, I'm going to cash it in for right now, and maybe I'll revisit this sometime down the road. Now, John made a point earlier that they believe, BlackRock believes that, you know, it's an opportunistic time because of wide discounts. You know, I don't think we're there yet. I think because, especially in the muni space, because we've only seen the share prices remain stable. When the net asset values start to fall, and they will fall when interest rates really begin to move, I think you're going to see the share prices fall again as well. We've had a little bit of a resurgence here in the last week or so because everyone's so focused on Greece and everyone's so focused on what's happening in the equity markets, people are seeking safe havens. So the safe havens right now are, of course, treasuries, U.S. treasuries, and they're starting to look at closed-end funds again because they are wider discounts. They tend to be more investment grade, and so you're getting people coming back to the safe havens. You're not seeing the same thing on the taxable fixed income side in closed-end funds. You're not seeing the same thing on the equity side in closed-end funds because they tend to have a little bit more risk involved or perceived risk. So it doesn't really have to be always on the interest rate side. A lot of it has to do with fear in the macro markets that may move away from that, such as Greece, China, or anything else that you may have sort of as the brand of the day in terms of issues with the space.
Thanks, Ken. Maybe Bob, can you tell us a little bit about liquidity in the closed-end fund market and how investors may want to do a better job or be more efficient at trading closed-end funds?
Sure, and I just want to pick up on a point that Ken made earlier, and I actually agree with you. In the research community, you know, whatever can be done to put more analysts out there because this is a retail product. But I would also say any advisors that issue closed-end funds or have closed-end funds, they need to support them as well. They need to have folks like that are going to be on the line and talking about them. Closed ends are not mutual funds. Mutual fund performance is measured by the NAV and the distribution period. But the closed ends are stocks, and there's emotions to stocks. It requires conversation. It requires dialogue. Much like having analyst support, I absolutely believe that the advisors that manage these should have support, supporting their field and their shareholders. So I'll take you one up on that, Ken, as well. As far as liquidity is concerned, you know, it's interesting with funds. And to the point I made earlier, I think that oftentimes when the market becomes under stress or under turmoil, and you see this often at year end where you have tax loss selling, where the hypothetical Mrs. Jones will have to make a decision whether she'll sell, you know, Apple or Hershey or IBM or XYZ closed-end fund. Well, many times she'll sell the closed-end fund because you don't necessarily fall in love with a closed-end fund, but you do fall in love with Apple or Hershey or IBM. I don't know why you wouldn't fall in love with a closed-end fund, but that tends to be the way it works out. So there are oftentimes buying opportunities when those things happen, when you have market dislocations, when you have the stock NAV relationship that oftentimes trades out of whack because the stock is moving in a different direction than perhaps the NAV is. The NAV is doing well because the sector is doing well, portfolio manager is doing his job, or for whatever reason the stock isn't doing well. So I think there are many factors that can be looked at and assessed when looking at the closed-end fund market. A lot of times volume has to do with it as well. So you know, these are things that I think that as a takeaway for the folks that are on the phone listening. You know, because there is inefficiency in this market to a large extent, that means that there's opportunities. Because bear in mind, all these funds have investment theses that are oftentimes different from other ones. And you have to ascertain what is the investment thesis that you believe is going to work now, and how is that portfolio doing in the context of what your thinking is with that investment thesis. So there are opportunities there. I think they have to be, you have to look at them.
Thank you, Bob.
And Bob, just to follow up on that, I'd say, and John talked about the mergers. I think mergers are very helpful in terms of sort of making deeper pools in terms of the closed-end fund space. And you know, what I've learned in terms of trading in the space of closed-end funds is market orders. You just don't do them. If you're moving in and out of closed-end funds, you're better off putting limit orders in because you know, the move to pennies, while it may have worked great for some of the stocks you named earlier, John, like IBM and Hershey, for closed-end funds, it actually probably didn't work as well, simply because the markets kind of disappeared. Now markets changed. No one shows their supplier what they need to sell like they used to. They don't walk up to the post and say, I need to sell 100,000 shares anymore. A lot of the market is VWAPing this stuff in, so you really can't get a feel for what's out there on the bid or offer side when you're trading closed-end funds. So definitely limit orders are probably the most prevalent walk away for the advisor who's trading in the closed-end fund space.
That's a great point, Ken, because if you look at oftentimes the volume in some of these closed-end funds and how maybe 100 or 200 share orders can change the price 1 or 2%, you know, within a matter of minutes, it's really quite remarkable. So I completely agree with what you're saying. You have to name your price. You can't necessarily let the market determine it, because it's just not that efficient in the way some of these trade.
I agree as well. Do try to avoid market orders. One more thing that we typically advise when purchasing closed-end funds, pay attention to the volume. Every once in a while we hear comments, oh, my client wants to put $500,000 in this closed-end fund. Well, maybe that closed-end fund only trades $50,000 on average every day. So definitely pay attention to the volume relative to the size of the position that you want. We typically instruct or advise not to have a position that exceeds 10% of the average daily dollar volume. You always want to think about the exit strategy, not just can I get in easily, but can I get out easily. So just a couple of tips to keep in mind. Now on to another topic that I feel that there's still a lot of confusion about that. We get a lot of questions on that, is return of capital. And this to all of you. Can tell us a little bit about return of capital. When does it happen? Is it good? Is it bad? When is it bad? When is it good?
No, it's, you know, Mariana, we've in the industry, folks in the industry, we've talked about return of capital for years in regards to the good return of capital, the bad return of capital. For the most part, it had been more prevalent. Return of capital had been more prevalent of a topic for equity-based closed-end funds, simply because there is the potential for capital appreciation. But I saw something amazing in the last year, as I saw a fixed income-based closed-end fund go to a managed distribution with return of capital. And again, you stick around long enough, you see everything. And I just start scratching my head in regards to that. But in terms of return of capital, you know, I think you have to look at it a couple of different ways. A lot of people will argue return of capital is a great thing, higher distributions, tighter discounts to net asset value for the investor, and it's tax efficient. And I check every one of those boxes and agree. Where you get into trouble in return of capital is when you continually return capital that exceeds the return on your underlying portfolio. So, for instance, if your return of capital is part of your distribution and you're paying out 10% distribution on an annualized basis, but you have a portfolio that's only returning 5%. Eventually, you continue to take from your principal pocket. You start to see net assets move lower, at which point share prices will follow that lower, and it almost becomes a self-fulfilling prophecy. And if that continues long term, you get a fund that came at 15, that trades to 10, that trades to 5, and eventually you have to worry about the long-term prospects for that fund in the secondary market. Possible liquidation may take place. The good return of capital is when, of course, you take that scenario where you're paying out 5 and you're returning 10, or the underlying net asset value is growing by 10% a year. So you're seeing NAVs move higher. You're seeing share prices typically follow those higher, even though they may still trade at a discount. That share price may continue to track that net asset value higher. I think in most part, again, talking about the equity-based space, we've really as an industry tried to diversify the offerings in closed-end funds, moving away from just fixed income to get into equities. And again, our whole industry was predicated upon equities back when they were first launched about 100 years ago. But in many instances, we've gotten into a little bit of a yield war, or a race to the top in regards to who can have the highest distribution rate for closed-end funds. And I think a lot of times that upsets that natural balance of the returns on the portfolio and the distribution rate you're able to pay long-term for the investor, so they actually get a good, solid, long-term investment. Those are my few comments. I'm sure others have more.
Ken, it's John. I'll make a point to that too, Mariana, that I think we've always found interesting here is, and Ken, I'll take something that you said and something that Bob said. On one point, closed-end funds, we all know, are used as income vehicles. And then Bob, you had mentioned that closed-end funds trade at stocks, like stocks. And the interesting thing, and I think what we all need to do a better job in the industry of too, is looking at closed-end funds just like you would look at a mutual fund. And what I mean by that is from a total return perspective, because I think the problem and why some of these funds trade at discounts is a lot of times, especially on the equity side, is they're a bit misunderstood, Ken, because of things like return of capital. And just to give you a prime example, you may have an equity fund that came out at, let's say, around $20 or so, and it pays a 7 or 8% distribution yield, which is something the client wants. That's a really attractive yield. And Mariana, we hear a lot of times, oh, this fund's kind of been a dog over the last 5 years. The equity markets have been going up, and I bought this at 20, and it's still right at 20, right? And to me, that's the perfect example of we've taken those capital gains and we've paid them out as distributions, and we've paid you that 7 or 8% yield, and all along your NAV and market price has stayed pretty stable. But people only look at the stock price, right? Because everybody always remembers what they bought a closed-end fund at. And they don't look at the total return. And so I think one of the things that everybody on the call should do is just make sure you don't look at only the price of your closed-end fund. If you're getting that 8% yield, just know that it may not show up properly on your statement. And if you're getting an 8% yield and you bought it at 20 and it's still at 20 and you've clipped that 8% coupon for the last couple of years, the fund may actually be doing what it's supposed to be doing. And I think there's a lot of disconnect and misunderstanding about that in the industry. And so not necessarily on the return of capital conversation itself, but it's something that I think we all in the industry are constantly dealing with and need to make sure there's awareness around.
John, I would agree with you. I think that this industry has painted itself into a corner by preaching income all the time. It is about total return. In any investment that you buy, it's about total return. So you can't just look at, hey, you know, this is the yield or the distribution rate I'm getting on a portfolio. Interestingly enough, the ICI puts out a study every so often, and they talk about the investors in closed-end funds. And the reason why I think total return is important, because according to the ICI study, 50% of the investors in closed-end funds are retired. Now, we understand retired people are looking for income. I agree with that. But retired people aren't producing any more principal if they're truly retired. And so their principal is very important to them So total return thus has to play into the fact that they're taking in an investment that can't all come back to them just as income, and to hell with the principal. You really have to look at the total return aspect of any investment, especially in the closed-end fund space. So, John, I agree with you.
And that's why, and I just to cover that with both of you folks, that's why I think when we talk about closed-end funds here at Calamos, we talk about it in the context of use the closed-end fund space to enhance either income or total return or whatever else you're trying to do for your client by supplementing that with the holdings that your client has as far as an asset allocation strategy is concerned. So, if you have 50% in equity and part of that's in technology or in energy, or you got 50% fixed income and part of that's in corporates and munis, then it's not a bad idea, again, to supplement whatever those holdings are by investing a part of it in a closed-end fund that invests in that sector as a way, and look, the demographics of this country are that they are getting older, the boomers are retiring, and they're going to need a little bit more income, to use the closed-end fund as a tool, again, to supplement those particular sectors. I don't think it's necessarily a good strategy to invest in any given sector completely in the closed-end fund space because, again, as you mentioned, Ken, we have gotten a situation where we are in a yield war. So inherently, the closed-end fund that will have to maintain a, call it 8% distribution rate to stay competitive and to mitigate a big discount, is going to have to be paying out some income and some gains that a mutual fund won't. And so, it mitigates to some extent the play in that sector because it has to pay out income. So that's why supplementing it, I think, is really a great way to take advantage of the vehicle.
Yeah,
John, I agree with you.
Good point. A good point. And the way we see it is first make the asset allocation decision. So let's say, okay, I want my portfolio to be X% in X asset class, let's say munis, and then make the vehicle decision. Okay, I want to be maybe more conservative, more plain vanilla. It could be an ETF, it could be a mutual fund. I want a little bit more yield, maybe use to supplement some leveraged muni closed-end fund. So again, first the allocation decision, second the vehicle decision, as opposed to, oh, I want to invest in closed-end funds as an asset class. No, it shouldn't be that way.
Exactly.
No, and Marianne, and John pointed out this earlier. I view closed-end funds as really satellite off a core holding. They shouldn't be the core for most people. They're a satellite complementing your municipal holding, complementing your equity holding. Completely agree on that point.
And I will also say this. I know there are a number of advisors on the phone, and many advisors are, depending on what their book looks like, they're hesitant to use closed-end funds because from an economic perspective, it may not make sense for them. But I would, and I was an advisor for a while, I'll share this. I think anytime you give a client a good idea, it's going to work out for everybody. And so touting a closed-end fund to enhance whatever areas in their portfolio that they want to enhance, although you may not necessarily get the type of compensation you would on a mutual fund that pays a trail, a good idea rewards everybody in the end.
Great. Thanks. And with that, I do see some questions coming in. So let me ask that to the panelists. The caller is asking, what duty do fund sponsors have to closing the discounts on their funds through actions like share repurchases and tender offers? She says that historical evidence suggests that those actions are not successful over the long term. And what should fund sponsors do in an environment where discounts are this wide?
I'll go first on that, Mariana. I agree with the caller. I think tenders, share buybacks are window dressing. I don't necessarily think they work long term because in essence, in some instances, you're worse off because the fund is smaller, fixed costs are spread among fewer shares, so expenses can go up. Trading, as we talked earlier with mergers, why mergers take place is to get deeper pockets, deeper trading. You may even get trading that lightens up in a particular fund that does a repurchase or that does a tender offer. A lot of these are really driven in many instances by dissident shareholders wanting to get themselves out. And I think we always paint discounts as with a broad brush that they're bad. Discounts aren't always bad, especially if you have an asset class that's working, share price is moving up, NAV just happens to be moving up a little bit quicker. That's a great scenario, and you'd be an investor in that all day long. But I think sponsors are responsible for discount management, and a lot of that goes back to, as Bob mentioned, education. Getting out in front of the advisor on an ongoing basis, not just when you do an IPO, but your wholesalers in the field are constantly talking about the secondary market. You have a program through your board of directors to consistently talk about discounts, consistently talk about funds in the secondary market. Imperative to make that happen. Where people get frustrated is when they can't get information and people sort of shut them out because, hey, you know, it's a captured asset base. We don't really have to do anything much going forward. So those are my comments.
I agree with you, Ken. I just want to highlight one thing. I think a share purchase program by the fund is a different scenario than a type of an advisor purchase program. There you have the advisor buying the shares versus the fund sort of self-liquidating. I think that's just a different dynamic, just to make that point. The other thing I would say is this. I mean, again, there is a concern with discounts, but I think you have to look at what's the total return of the stock price. That's what matters. Would you rather have a fund that's trading at a premium but has a total return of 5%, or a fund that's trading at a discount that's had a total return of 10%? I think the answer there is pretty simple. Again, it is education. It is getting out. I mentioned earlier, it is a stock. It is a stock, and when you are a stock, you're a company. You have to. It's public relations. You need to get out and you need to educate. You need to talk to your customers. You need to talk to your shareholders. It's a very different dynamic than a mutual fund, which really you're relying on the portfolio manager and the team to do the heavy lifting with respect to the return of that fund. With a closed end, yeah, that matters. The NAV is the driver, but talking about it and supporting it, I think, go a long way in helping the stock perform.
Great, thank you. There's another question that I have is why you should not look at stocks the same way as closed-end funds. I know we talked a little bit about total return, but can you tell us how one should look at a closed-end fund very differently from a stock that you buy at the purchase price and end price, and may not, especially those that might have much of a distribution? And unfortunately, too many people still think of closed-end funds just like plain stocks. I bought it here, now it's here, how disappointing. And in fact, sometimes we get those questions, and we actually look at the total return, and the picture is completely different. Can you address that question, please?
Hey, Mariana, it's John. I mean, I think we hit on it already. I think what you said and what we had mentioned earlier is the right reason. You know, and stocks, obviously, especially stocks that don't have large distributions, are going to trade differently. I think the only other point that I would make, and I think Ken started to bring this up, is, you know, closed-end funds are also going to be more volatile than stocks, and I think that's both a good thing and a bad thing, right? It's a bad thing when we own them, and volatility can be painful at times, but it is a reason why I think discussions like these are interesting, right? Because it is a fairly inefficient asset class, and there's a lot of asset classes that aren't in that same bucket. I think you know, large cap stocks have become pretty efficient. I view a lot of closed-end funds almost like a micro cap stock. To Ken's point and Bob's point, there's not a ton of analyst coverage. You really have to do your research to understand what's going on. There's a lot of things that are misunderstood about them. So if you do your research, you can find some pretty good opportunities in closed-end funds. As we talked about, you need to look at the total return. Don't think about it as stock in that regard. but they are going to be more volatile. And the last thing I'll say is because of this and because of regulation and change, we have seen them become even more volatile, right? The market makers aren't stepping in as much. There's a lot more volatility in closed-end funds, and so just keep an eye on them. I think the tip from Ken to put in market orders is a good one, but they're going to be much more volatile here, and I think that can create some opportunity, and it can also create something that you need to keep a very close eye on these.
And Mariana, I'll add to that. You know, there's certain instances in closed-end funds, you know, and maybe it's a once-in-a-lifetime thing. Like let's take munis for example, where you really get a chance to hit a home run. You know, coming out of 08, if we all recall how desperate things were, investors at the beginning of 09 in muni closed-end funds, if they held it the entire year, they made somewhere between 40 and 50% in total return. But we all know that's not what bonds are all about. Bonds are typically about clipping the coupon. And so a lot of the fixed income closed-end funds are meant just for that. They're meant for clipping a coupon, getting your 5, your 6, your 7, depending on your asset class, getting that yield on an ongoing basis. And maybe you get a chance, you know, post taper tantrum, where you get that opportunity for a great total return in municipals, or post 2008 where you get that opportunity. Where you get more of an opportunity in total return outside of fixed income is really on the equity side if the strategy that the managers put forward hasn't really turned the equity portfolio into a bond proxy. They're out there. As John said, you got to do your homework. You got to sort of dig through the weeds to find it. But there's funds that are out there that produce very nice total returns, still produce some income, but produce very nice total returns on an ongoing basis. So, yeah, you got to think of them as stocks, but I think that reference was meant that not every closed-end fund is the same, that you have to really look underneath the shell of what the closed-end fund is, that structure, and figure out what the manager is investing in.
I think it's about valuation, just like you would look at any stock. Okay, so you may, you know, for example, let's say in your client's portfolio you see a need for muni. You'd like to buy a muni. Okay, you want to give them exposure to the muni market. You want to do it in the context of a closed-end fund. Okay, what manager do you like? Who's got a good track record? Who's been in the closed-end fund space? You know, many check boxes that you'll want to check. And then you look and see how has that fund been trading relative to its NAV. And all things being equal, if you like the space, you like the sector, you like the manager, and you don't necessarily feel you have to buy it today, but you want to get in a good point, a good entry point, just like you would a stock, then watch it. Watch it. If it's been trading at a 5% premium and you see it drop down to a 5% discount, maybe that's a time to consider it. Or you see it trading at a 5% discount, it's now dips for whatever reason down to a 10% discount because there's been some dislocation in the market that doesn't necessarily or wouldn't necessarily impact the performance of the underlying portfolio. In other words, the NAV has been stable, but the stock starts to dip down. It's paying its distributions. There's not a lot of negative return of capital. In other words, it's not cannibalizing its NAV. All things being equal, and maybe that's a good entry point. So the analogy there being looking at like a stock is that like a stock, you want to buy it when you feel it offers value, when it's a good entry point. Closed-end funds are very much the same way.
Great, thanks. And Calamos First Trust and Blackrock have great websites that provide a lot of information on their closed-end funds. You can look through to the portfolios, the breakdown, the asset class breakdown, or details on each of the portfolios. They're great. They also provide total return in case you don't have access to total return calculations. And so I would encourage you to visit those three websites. We are at 12, and we're going to finish here, but would love to thank Bob, Ken, and John, our panelists, for great comments, very insightful observations, and have a great day. Thanks very much for listening to this call.